Have you ever felt like you're working harder, earning more, but somehow actually falling behind? Well, you are definitely not alone. In this explainer, we're taking a deep, cinematic look at the modern American balance sheet. For a lot of people, especially those right in their prime working years, there's this lingering, frustrating sense that true financial progress is just totally stalled out. So today we're going to decode the structural realities of the economy using cold, hard data. We're going to uncover exactly why building wealth feels so incredibly difficult right now. I want to start right here with a really striking quote from the Federal Reserve's Beige Book. Listen to this. Middle-income households are squeezing more life out of every dollar before deciding to spend it. Now, that isn't some dramatic headline from a financial blog. That is the sober, measured assessment of the U.S. central banking system. And it absolutely nails the defining economic mood of the American middle class today. There is an undeniable friction in our day-to-day economy. And to really understand it, we have to look beneath the surface. Act 1. The macro squeeze. Right now, we are living in what economists call a bifurcated economy. Basically, that means the top-line economic growth we hear about on the news is actively masking the deep, day-to-day strain felt by middle and lower-income families. The data tells us that high-income households are staying incredibly resilient. They can just absorb higher costs without really changing their habits. But middle and low-income consumers, they are under serious financial stress. Retailers are literally describing their customers as extremely price-sensitive. We're even seeing widespread shifts where families are abandoning planned vacations and opting for staycations just to offset the high cost of fuel and basic living expenses.
Act 2. Income versus wealth. This is a crucial distinction at the core of our economy.
Whenever we talk about inflation, the conversation almost always centers around metrics like the CPI, the Consumer Price Index. But if you look closely at how the Bureau of Labor Statistics actually defines these metrics, it's quite revealing. They're explicitly designed to measure the hypothetical lowest expenditure needed just to maintain a standard of living through day-to-day consumption. We're talking groceries, gas, basic shelter. Fundamentally, these metrics just measure the cost of survival. They do not measure the cost of financial progress. And what's truly fascinating is what the CPI explicitly leaves out. Because it strictly looks at consumption, it totally ignores the exact assets required to build long-term wealth. Stocks, bonds, buying real estate, business investments, none of that is factored into the CPI. So when you hear a report saying wages are keeping up with inflation, you have to remember that just means wages are keeping up with the cost of milk and rent. It tells us absolutely nothing about your ability to buy a home or invest in the market. And the reality of wages right now is pretty stark. While nominal wages did grow during the post-pandemic recovery, when you look at real wage growth, which is adjusted for that daily inflation, it's actually falling for the bottom earners. Recent data shows that the bottom earning tier has literally dipped below the other income groups. They are actively losing purchasing power.
So it all boils down to this. An income allows you to consume, but only assets allow you to build wealth. If your paycheck is solely keeping pace with the CPI, you're just treading water in the consumption pool. You are entirely cut off from actually building wealth because every spare dollar is being absorbed by the rising costs of basic survival.
Act 3. The housing lock-in effect.
Let's talk about housing. As of mid-June during the reporting period, the prevailing 30-year fixed interest rate for a conventional mortgage stood at 6.8%. Now, for anyone trying to buy their first home, that rate, combined with already elevated home prices, is a massive, towering barrier to entry. But what's even more fascinating is what this rate does to people who already own homes. When you look at the data from the Federal Reserve, there is a wild contrast in outstanding mortgages. The vast majority of current homeowners are sitting on mortgages locked in way below 4%. A huge chunk of them are even under 3%. These are folks who locked in those historically low rates before and during the pandemic. And this creates a massive systemic issue. As mortgage rates spike, existing home sales just absolutely plummet. Why? It's a powerful lock-in effect. Think about it. Why would a homeowner trade a 3% mortgage for a 7% mortgage to buy a slightly bigger house? They wouldn't. They're effectively wearing golden handcuffs. This completely freezes mobility, it strangles the housing supply, and it locks an entire generation of younger buyers out of the primary wealth-building mechanism in America, homeownership. Act 3, continued, the consumer debt burden. So when your income is totally consumed by basic living expenses and housing equity is frozen, what do people do? They turn to debt. But financing conditions right now are highly restrictive. Borrowing costs are high. And as these credit flows start to tighten up, consumer sentiment just plummets. People are really feeling the physical and mental weight of this financial leverage.
The underlying data here is honestly deeply concerning. Delinquency rates for things like credit cards and auto loans are now pushing above their historical medians. And to make matters more complicated, with the pandemic-era safety nets completely gone, everyday Americans are facing the resumption of federal student loan collections. According to the Department of Education, more than 5 million borrowers are currently in default. 5 million, and over 4 million are in late-stage delinquency. That is a massive segment of the population watching their balance sheets actively degrade.
And this kicks off a really vicious cycle. Because the student loan on-ramp period has expired, these delinquencies are once again being reported directly to the credit bureaus. Delinquencies hammer your credit score, and in today's world, your credit score dictates your financial access. A damaged credit score effectively throttles any future access to wealth-building credit. It pushes people further into the realm of high-interest, predatory lending just to survive the month.
Act 4. The structural reality.
Pulling all these threads together, the economic reality you experience today depends almost entirely on which side of this bifurcated economy you sit on. If you already hold assets and have a high income, you're fine. You can absorb the shocks. You keep spending on services and durable goods. But if you're in the middle or lower tiers, you are facing severely deteriorated affordability. You are the ones swapping out the family vacation for a staycation and fighting to squeeze every last drop of life out of every single dollar.
And there's really no better proof of this structural strain than the personal saving rate. After seeing these massive, temporary spikes during the pandemic, mostly driven by fiscal stimulus, the saving rate has just cratered. It remains depressed well below its pre-pandemic baseline. Everyday costs are literally eating away at disposable income, leaving barely anything left over to save, let alone invest in the future.
So, let's look at the big picture of what we've explored today. Building wealth is stalled. Paychecks are being completely consumed by inflation. And remember, that's an inflation metric that only tracks survival, not the cost of acquiring assets. Homeownership mobility is frozen solid by the mortgage rate lock-in effect. Future growth is being suffocated by compounding consumer credit and student debt. And wage growth for lower income tiers is visibly slowing down. The gap between those who own assets and those who earn wages is widening into two entirely different economic realities.
Which leaves us with this final, absolutely critical thought. We've seen the data. We know exactly what the structural barriers are. The ultimate question we have to face right now is this: how does the everyday American transition from merely financing the cost of living to actively building wealth in this new economic reality? How do we bridge that massive gap between just making a living and actually building a life? Take a moment to think about that as you look at your own balance sheet. Thanks so much for joining me for this explainer, and keep questioning the numbers.